Okay, good morning, everyone. Thank you for joining our webinar today. We will be discussing research that was recently conducted on fintechs, their experiences and adaptation models during COVID-19, as well as with their customers, financial health and experiences. And we'll be speaking with two fintechs that are working on the ground, but working very hard to respond to customer needs. Before I begin, actually, I'd just like to give some quick housekeeping. As you know, everyone is on mute, and we would really encourage everyone to submit questions in the chat box, and we will make sure to answer your question as time allows at the end of our presentations. We've left about 15 minutes for questions as well. So I'd like to introduce our panelists. Sorry, I was having some technical difficulties there. I'm really excited about all the panelists that we have joining us today. To start, my name is Maha Khan, and I am the Senior Director of Strategic Initiatives at the Center for Financial Inclusion at CFI. I'm joined by Malika Anand, who is the Head of Learning and Insights at Catalyst Fund, Sitara Merchant, CEO of Swiss Capacity Building Facility, Andrew Mutua, who is the founder and CEO of PesaKit, that provide mobile money agents with assistant app, and Megan McCormick, co-founder and CEO of Oze, providing digital record keeping to SMEs in Africa. Before we jump into the presentations, I would like to hand it over to Sitara to kick us off, please.
Thanks, Maha. Thank you, everyone. It's a pleasure to be on this webinar, and we hope that you'll get lots of knowledge and information out of this and really enjoy listening to the two fintechs that we have that we'll be having a discussion as well. I wanted to take a few minutes to just talk through who SCBF is. We're not so well known, so next slide, please. SCBF is a technical assistance grants facility. It co-funds projects that are for developing innovative, client-centric financial products and services. Since inception, which was in 2011, we have funded over 13 million, and that's Swiss francs, in TA facilities, and that TA assistance is actually provided to the partner financial institution. This is across 42 countries. And these PFIs, or partner financial institutions, have reached over 2.1 million low-income populations, particularly women, smallholder farmers, micro, small, and medium enterprises, as well as other rural populations. Next slide, please. We've worked with, you'll see on this slide, we've worked with almost over 36 technical assistance providers and 91 partner financial institutions. Many of these are fintechs and insurtechs, so they're included in there. We strongly believe that these fintechs and insurtechs hold a great promise to move the needle on financial resilience and access to health and other basic services for underserved populations. It's the innovations that these fintechs and insurtechs are able to do in their delivery mechanisms or the design of their financial products, their business models, that really allow for new and innovative, and especially from a volume base, to reach these underserved populations. So when COVID-19, the pandemic, hit, we were looking at the different types of research and the different studies that were being done on the market. And one of the things that we found is that a lot of the emerging evidence was on how individuals and how SMEs on the demand side were being affected by the pandemic. There was little to no evidence on the supply side. So we were asking ourselves the question, how are these tech-enabled providers really being impacted? These are the sort of the engines when everybody was in shutdown. These were the engines of how people were accessing financial services. So they were critical in being able to mitigate the economic effects of the pandemic. So we're really curious at the time to understand how are they deploying services, were they agile enough to be able to do this within the lockdowns? How client-centric were the products and services they were developing? And so we're really trying to understand that. And as part of that, what we did was we partnered with CFI to conduct a study to understand the impact on the role of these fintechs on the COVID-19 pandemic. At the same time, or about the same time, the Catalyst Fund conducted a study on how users are being impacted on COVID. So really, today's discussion is going to be about how the demand and the supply side have been affected by the pandemic. So on that note, I'll pass it back to Maha to take us through the first study.
Great, thank you so much for that, Sithara. I will just, so as Sithara mentioned, there is emerging evidence around low-income households and MSMEs, their experiences and financial health during this pandemic, but less so on the providers that are serving these customers, especially fintechs. And we know that fintechs are very well placed to mitigate the economic impacts of the pandemic, particularly because they can deploy services quickly and efficiently. So we wanted to dig into this a little bit more and understand their adaptation models. And so in partnership with SCBF, as Sithara mentioned, we surveyed more than 400 early stage inclusive fintechs through the 2020 Inclusive Fintech 50 competition, the applicants, as well as surveyed some of the 2019 Inclusive Fintech 50 winners. We have 5 overarching findings, which I will briefly walk you through today. The first is that actually COVID-19 gave the impetus to fintechs to leverage their unique skills and assets to digitize their features and services even more than they have done in the past. So particularly fintechs that serve businesses, we found that they were able to expand business opportunities and increase the number of partnerships that they had, such as with e-commerce platforms, logistics service providers, and then more traditional organizations like banks, as well as NGOs. COVID-19 has actually almost forced the more traditional organizations to accelerate their digitization process. And what we saw was that these organizations are turning to fintechs, as the quote on this slide demonstrates, to help them with that. We had a fintech that works with banks in India in our sample note that they actually created 12 new partnerships with banks as they were helping banks digitize their compliance measures. We also noted through our data, the data findings suggested that fintechs are actually demonstrating operational resiliency. Fintechs have had to make really difficult decisions during this tough time, and our data indicated that they have really employed creative measures to keep their staff on board. So taking measures of working from home, shifting to part-time work, as well as cutting salaries to actually conserve cash. We noted that the median number of employees actually didn't change between December 2019 and May 2020. These are the 2 data points that we had asked for in our survey. So it went from 6 employees, the median number in December 2019, to 7 in May 2020. They are relatively small, the early stage fintechs that in our sample, but even if we looked at fintechs that had more than 50 employees, only 30% actually decreased the number of their employees. And when it comes to cash runway, startups in general have cyclical funding, short-term funding, depending on their product cycle and product iteration, and preserving cash can be challenging, especially during a pandemic. And in fact, our data indicated that fintechs were able to maintain a cash buffer. There wasn't a whole lot of difference between pre and post, well, not post, we're still sorry, very much during the pandemic. So pre and during pandemic, 7 months to 9 months. Interviews that we had with investors indicated that fintechs are actually approaching them for bridge loans to help them weather the storm. And our data also indicated that for this year, fintechs are able to weather the storm. Early stage fintechs are responding to their customer needs by tweaking products or building or offering newer products around their core product. That was something that was very strong in our findings. We noted that payment services grew between December 2019 and May 2020, as well as surprisingly savings and financial management fintechs as well. We noted that savings fintechs are actually offering other products on top of their savings, or they are incentivizing their customers with flexible saving options. As I mentioned, bundling services, so offering things like mobile wallets, credit, micro insurance, again, responding to customer needs. One fintech in sub-Saharan Africa in our sample that is ride hailing actually added cargo services, as that was considered an essential service during the lockdown, to be able to provide their clients, their customers with the work, with income. So pivoting products and tweaking products was one of the adaptation models that early stage fintechs were demonstrating. Another really interesting finding that we had is that fintechs are also using digital delivery channels like platforms, so Facebook and WhatsApp, to increase uptake as well as increase customer acquisition. They are using measures like online marketing strategies, webinars, and training modules that are also online. So for example, online trainings for agents. And for those that may not be digitally native or be in, in rural locations in the last mile, we also noted that their fintechs catering to their needs and using, for example, SMS and radio communication campaigns to educate customers about products, to acquire new customers. In fact, one fintech in India noted that they switched from door-to-door campaigns to SMS and radio communications, of course, in light of lockdown measures. And they had a 15% conversion rate through SMS and radio versus 17% from door to door. So indicating that the SMS campaign worked quite well with less sort of human investment required in that and respecting the social distancing or lockdown rules. Lastly, just also briefly, obviously, we've noted that fintechs have demonstrated operational resiliency, agility in terms of tweaking products, adapting their products to customer needs, as well as expanding partnerships. But in order to be able to provide these solutions to customers, they will need funding to continue innovating and continue providing services. What was interesting is that in March of this year, we complemented this research with some interviews with investors who had noted that they were doubling down on their portfolios and helping their portfolio weather the storm, and had noted that, later down the line this year, they would be ready to look at fintechs that are offering innovative services to customers. More than a quarter of our over 400 sample size, actually noted that they did not change their fundraising strategy. This was in May 2020. And so when we dug into those that have changed their strategy, as this graph demonstrates, we noted there were different approaches slightly by depending on the stage, the growth stage of the fintech. So self-funded, seed, we're no longer only looking at equity investments, for example, but also shorter term investment instruments like debt financing as well as grants. And later stage, we're looking at a mix of instruments such as debt financing, equity. But some of our data indicated that there are some fintechs that were willing to accept reduced valuations because of the need of funding. So again, when we did ask early stage fintechs what their biggest needs were at this point, was an access to an investor network, as well as access to capital. And we do think that this is an occasion for investors to really rise to the occasion to assist fintechs in their continued innovation to respond to customer needs, as well as to allow fintechs to think through things as they increase their uptake and are tailoring products to customers, how consumer protection and ensuring that their customers are consenting to the data that they're giving as well. So I'll stop here for now, and I'm really looking forward to speaking with Pesakit and Jose on their adaptation models and any fundraising strategies, and also Malika's presentation on the user side of the fintechs that I have just spoken about. So I will hand it over to you, Malika.
Thanks for that, Maha. Lots of really interesting nuggets. So as Maha introduced at the beginning when we kicked off, as CFI and the Mix were implementing this survey with the help of Sitara's team, we at the Catalyst Fund took advantage of our connection and network directly with fintech startups and the relationships of the Mix to reach out to fintech users. Mahak, do you mind going to the next slide? What we did is develop a web survey that we shared with fintech startups that elected to participate, and they went ahead and shared that link with their users. We had almost 700 respondents to the survey across 7 countries, largely African countries. We think it's a really interesting data set compared to the multitude of data that we're seeing right now about COVID response, because it represents a very specific user group. So, and perhaps a user group that might be more resilient in these countries that we care about so much, right? So these are digitally savvy folks that are sometimes SME owners, but that qualify for digital services, that are using smartphones. And while they're probably, suffering the brunt of the COVID pandemic in terms of lockdowns and limitations and breakdowns in market functioning, they might be the ones to be the most resilient and leading us out of it, right, as markets open up. So I should say now that this data is maybe 6 or 8 weeks old. So we'll look forward to Megan and Andrew updating us from their view on the ground. So the overall picture, I think, is that we found is consistent with what everybody else is also finding. Fintech users, like much of the populations in emerging markets, are seeing decreases in income. In fact, over 3/4 of the people that we spoke to report that their incomes have decreased, while simultaneously finding that their spending on essential goods is increasing. So almost half of our respondents noted that, in fact, their spending on just essential items had gone up. So we can imagine that that contributes to an overall environment of financial pressure on the household. What we found interesting is when we started to delve into the more specific segments in our group, the first thing that we observed is that seniors are perhaps the most vulnerable of the group. Oh, excuse me, I forgot about the slide. Actually, I'm gonna go back for a second. Just a few more details, I think, on the overall population. More than half of the users that we spoke to say they have a loan outstanding, and 62% of those say they'll have trouble making their loan payments. I'm sure that our fintech partners are not thrilled to hear that, but as expected. These respondents, when we spoke to them a couple months ago, at that time said they had fewer than 4 weeks of expenses. I mean, savings to cover those expenses. So we can anticipate that as lockdowns were ending, their savings were diminished or depleted, and that now they're working hard to rebuild those financial bases and their livelihoods and businesses. And almost half have no insurance coverage. Again, I think this fits with what the data that we're seeing across the industry, across the sector. To revisit where I was going, what we noticed when we started digging into the segments in the data is that seniors seem to be the most vulnerable. What you see here is that seniors are reporting in the greatest numbers a significant decrease in income and a significant increase in costs. Added to this, we found that seniors report they will not be able to make loan repayments at higher rates, and that working age people and youth seem to be better able to manage both their income streams as well as what they're spending on expenses. This may be because seniors are more dependent on traditional sources of income and maybe less able to adapt to digital ways of doing, right? So we've heard that youth might have been able to leverage digital financial services to take advantage of digital commerce or gig work. And this might explain why they're seeing shallower dips in income and are better able to adjust to lower sources for making purchases and consumption. perhaps more surprising is that women may in fact be showing more resilience than men. I think we've seen a lot of data thus far that has shown that women are closing their businesses at higher rates. But when we asked more questions about this, what we found is that it might be that closing businesses, or at least shuttering them temporarily, is helping women manage the expense side of their budget. So they might not be paying rent, they might not be buying supplies, or have outstanding debt on their businesses, and so they're able to shut them down in a way that men who have higher fixed costs are unable. So what we see in this graph is that men are much more likely to report decreased income, whereas women are more likely to report no change or even increases in income. I'm gonna stick with that for one more second, Maha. Alongside this, we found that women were more likely to report being able to repay their loans. We're more likely to report having insurance products, which for us was a surprise, and it might just be a feature of the fact that these are fintech users. These are women who are able and have access to financial products. What we found in terms of household spending was very interesting. We found that men and women report equally sort of changes in what's happening at the household level, but women business owners report that business revenue has been sufficient to maintain their desired levels of operations. So almost half of women say business is sort of okay, not great, but I'm at least maintaining the level that I want, whereas many fewer, not about a quarter of men, say the same. And finally, I think that I think this complicates a little bit the picture of what's going on with women in a really important way. That what we know sort of from our old days of microfinance about women being less willing or less excited about growing their business, or wanting to take on big investments or take on rent or these kinds of fixed expenses, might actually be protecting them in these times of difficulty. Now, next slide, Maha. The good news, I think, is that these users are utilizing and leveraging their relationships with fintech startups. About 50% of the users we spoke to have used the fintech startup services since the onset of the pandemic. An additional 25% have tried, but were unable. And those responses were largely from one digital lender who I would guess is facing some capital crunch at this time. And that 100% of people who have used those services say that they've been useful. So they're finding that whether it's expense reporting in the case of OZE, or if it's income generation services like the ones Pesakit provide, or digital lending, it's the sample represents really a range of fintech services. Users are finding them to be helpful in these difficult times. We also asked what they would be looking for going forward, and perhaps unsurprisingly, 2/3 said they were hoping for additional access to credit. And perhaps surprisingly, 1/3 are saying that they want access to savings. So even as savings are getting depleted, and even as resources are low, families are looking forward and thinking about wanting to save more. And in fact, this fits with established research findings that, having gone through a crisis, households are more interested in shoring up their financial lives. So I think our friends in the industry can look to that trend in the coming years. Unfortunately, and I'll ask Maha for you to go to the next slide, there is a group of impacted users that I think are getting left behind. So when we cut the data by reports in terms of decreases in income, we found that those who reported significant decreases in income were much more likely to report a number of other troubling things, right? One, that they are unable to pay their existing loans, but want to take on additional credit, right? So we should be aware and perhaps slightly preoccupied about issues of indebtedness going forward as people try and rebuild. That group is also more likely to be denied fintech services currently. So, I mean, this makes sense from a credit scoring point of view, but what that means is that those most in need of resources, those most in need of resources to rebuild, are unable to access them. And furthermore, that they also report being less likely to access resources from other areas, right? So we found that people who reported no change or increases in income were better able to access resources through family and friends or personal networks, whereas those who have already lost a lot of income are not. And unfortunately, that same group reports then going to money lenders at higher rates, right? So, you know, this deeply embedded concern about high cost over indebtedness, I think is, we can see some of the symptoms already in the data. I want to end on a high note, this part of the presentation, before we actually get to the discussion with Megan and Andrew, by saying that we're already seeing, even within our Catalyst Fund portfolio, how fintech startups are leading the way in creating a response and helping people adjust to this new normal. We know that there's a clear demand for credit and that there are large gaps in insurance, and that startups in our portfolio and the ones that we're talking to around the world are already thinking about how to innovate and adapt in order to meet those needs. We're seeing Turako and Wella Health, again, two African insurtechs, who've released sort of weeks after the pandemic was announced, hospitalization policies so that people could get the care that they needed. We partnered with a startup that provides, it's a sort of credit and inputs to SME retailers in Kenya to create an e-voucher program that both made sure that the retailers had demand that through vulnerable households and could continue to earn during these difficult times. Another one of my, a model that I think is amazing from South Africa, Abilobi, works with small fishers to supply restaurants. And again, within days of the pandemic being imposed and restaurants shutting down, innovated their platform so that fishers could sell directly to households. We work with two startups right now that are salary advance startups, and we're learning firsthand just how important salary advances and getting access to liquidity when you need it is during these times. And I'd also like to highlight Quora, which is a digital banking platform for co-ops that innovated a new way for co-ops to be able to offer, to digitize quickly, to be able to continue providing services to their members even under lockdown. So I think that sets us up really well to move to the conversation with Megan and Andrew, who, you know, are best placed to tell us about what's happening on the ground, both with users and also with how fintech startups are responding. So maybe I can ask you guys in turn, Andrew first, and then maybe you, Megan, afterwards. What do you see happening? What do you think is happening with fintech users? How is the environment changing how they use their products? Why don't you start by giving us an update?
So for the users who we've had since early in the year, we saw a decline in incomes in March, April, and May, and to some point to the lowest point of about 50% decline in income. So what that prompted us to do was to rethink some of the product offerings that we have and develop new opportunities for them to generate more income for their businesses. So what we are now starting to see is an uptick even for fintech users who didn't think they need other revenue generating sources. So we're getting new users, acquiring new users who their first interest is the new digital commerce services we are offering. Then the second one is the liquidity service. So we are starting to see a new type of customer that we're onboarding, a new type of agent that will use PesaKit in the future.
Thanks so much, Andrew. What I should have done actually was ask you to tell us just a tiny bit about your business. I know your business so well and I love the model, but let's just give the rest of our listeners a 10, 20 second elevator introduction.
Oh, cool. So PesaKit's primary customer is mobile money agents, and we work at the last mile. So our work is to enable mobile money agents to access relevant financial services that in turn will make them more reliable and more efficient so that they can have better impact in the communities they serve. So we have two products that are running at the moment. We have a liquidity product, which is a credit line for mobile money agents to request float when they need it. And the other one is a digital commerce service, which allows mobile money agents to resell digital goods and to become e-commerce fulfillment points at the last mile.
Thanks, Megan. Can I turn it to you?
Sure. So what Ozai is a app that makes it easy and habit forming for small business owners to record their financial data and then use it to make better decisions and access capital. And so we have very strong insights into what the pandemic did to the earning and expenditures of the businesses on our platform. And one of the first things we noticed was that by the third week in March, over 60% of our high active users had seen their revenue go to zero. And so we really needed to help these entrepreneurs who were using a smartphone apps. We knew they had at least some access to internet and some digital savviness to adapt their operations so that they could continue to serve customers without having a physical footprint. And so since Ozai already provides daily business education, we tailored all of our education to how to use vouchers if you're a restaurant, how to, promote goods like clothing and cosmetics when people aren't going out, and you also want to be kind of sensitive to the fact that a lot of people are suffering and not wanting to buy, non-necessary goods. And so we saw a lot of our customers, the majority of these customers actually be able to bounce back and get their businesses running. The second thing that we did was we made COVID relief loans available to active users on our platform. And we knew that it would be really hard for these business owners to take out a loan when they didn't know how long the lockdown period was going to be. And so in order to take some of the uncertainty out of it for them, we wrote a grace period into the lending contracts. And that grace period didn't start counting until the government officially opened up the lockdown on the cities in Ghana that were shut down. And during the pandemic, we've done probably about 18 small loans to our customers. We're still in the pilot phase. And despite, reduced incomes, we actually have not seen any defaults, and just 2 out of the 18 needed to refinance so that they could have lower payment amounts over a longer period of time. And so we found being able to base credit worthiness on the actual inflows and outflows of a business, those who had shut down completely just before the pandemic and those who were still operating their during the pandemic inflows and outflows, was actually a highly predictive way to provide credit to small business owners.
It's fascinating. And just before I move on, can I just remind everyone, if you have questions for any of us, to just go ahead and put them in the chat. One thing that I think is so interesting about both of your models is the extent to which, small business owners and mobile money agents have a pulse on what's happening in these communities, that we know even from the brief description you gave of the activity that they're seeing, what's happening in their communities. And without speculating too much, do you maybe want to give us a sense of what you think is going on with these vulnerable families?
So here in Kenya, we had a challenging time during the lockdown between March and early September. So now is when, from September and October, is when we're starting to see economic recovery amongst the agents and also the communities they serve. And this we can monitor from the volume and value of transactions that an agent is doing every day. So during the lockdown period, we saw 50% decline until around May, when we started to see the transactions increasing because people had now gotten tired of staying at home or people wanted to start generating more income. So now what we're seeing with agents, they're getting to about 70% return on the commissions that they used to earn. But the challenge for them is still they're incurring a lot of high costs, and this is also true for their communities. So because there's social distancing, let's say on public transport, the cost of transport within Kenya has almost doubled. So like in Nairobi, moving from, let's say, where you live to your workplace is almost double the price. Then the other challenge is working hours. So previously, between March and about August, you could effectively just work for 4 hours because you had a curfew at 7 p.m. Then when the curfew was moved to 9 p.m., still the working hours were the same. So now the curfew as we speak is at 11 p.m. So in many communities now you can have a full working day. So you can start work at 6 and maybe close at 7 in the evening. So we're starting to see improved incomes because of increase in working hours, but still the cost is high. The rent is still, even if you're earning 70% of what you used to get, you still have the huge amount of rent that you need to pay that is consistent. Then now what we're starting to see now is even more increased pressures from last week when schools reopened, because now parents had to look for money for school fees, maybe transport for kids. Then there's all these new essential items that kids are requested to go back to school with. So the kind of transactions we were seeing at agent points were more of withdrawals so that people can go and purchase these items. But you can already see within this month, a lot of families and households will struggle because of the new activity of just schools being reopened and the amount you'll spend to get your kid back to school.
Yeah, I would say we're looking at a slightly different, universe of people, and so the perceptions are different because OZE tends to attract a small business owner who is not, they're not necessarily earning a lot, but they're a little bit more secure in their financial position. So they tend to be educated. Most OZE users have a college degree, if not more than that. And we're just not able to find formal employment and therefore had to go into entrepreneurship or actually choosing entrepreneurship. And in 2019, before the pandemic hit, we saw that 97% of businesses on our platform were growing and or profitable. So these were businesses that were able to start to generate wealth, were on a really strong and solid trajectory that maybe shored them up to the challenges that an economic downturn would cause. What I think the sentiment I most got from our customers was the fear around the uncertainty and the frustration that things had been going pretty well for them. And in order to keep, gaining on the strides that they had made, they needed to incur costs to change their operations in some way or change their business model. So a lot of them needed to figure out how to effectively cut through the noise of WhatsApp groups and actually sell products. Some of them had to actually figure out what is a new product that I can sell with the capacities that I have. And then some of them actually were selling products already before the pandemic that were good for this time. Like, let's say household cleaning products that we're seeing because so many people were getting into soaps and Clorox and sanitizers that they weren't able to access their inputs. And so there was all of this uncertainty about where do I find the money in order to pivot my business a little bit, but I don't know how long this is going to last. Is it going to get worse? Is my pivot going to work? And so people were hesitant about making those investments. So we felt a lot of angst from our customer base.
Yeah, I can imagine. And you gave us a little bit of hint about how OZE responded in the moment with the loans and a grace period. Do you want to talk us through a little bit how you guys responded?
To our customer base?
Yeah, as they're having all this anxiety.
Yeah, so we have a very strong relationship with our customers. A lot of them actually see our app as a person because we have this persona of the OZE business coach inside of the app. And so the busiest person in the company, especially during the early days of the pandemic, was our business coach because all of our users have access to message him and ask specific questions that they might have. And so that volume of specific questions greatly increased, and we really tried to support and give people the answers and the resources that they need to help them make those decisions and help them interpret the historical data to make those decisions based on data and not just based on emotion. And then we were able to kind of collate and aggregate the most commonly asked questions and turn those into actual seminars. So we started hosting seminars on Zoom. We did some seminars on Instagram Live and Facebook Live. And so that way we could, the topics that people really were asking about, we could cover off in more detail and actually bring in expertise from outside of the company so that they weren't just hearing the OZE perspective. So I would say, the loans were incredibly helpful to the business owners that got them, but those 18 loans during the pandemic are a tiny, tiny subset of our user base. And most of the users benefited from the education on how to tailor their business to the pandemic, and then also how to interpret their data, because they had been using OZI prior to the pandemic, they knew things like how much money they typically spent in a week. And so they could see, okay, this is my cash balance, this is how much I spend in a week. If revenue continues to stay zero, this is how many weeks of life this business has left. Okay, now let me look at which of my costs are fixed and variable. If I get rid of these variable costs, this is how many weeks that my business has left. So I think a lot of people for the first time really appreciated the fact that they had historical data to help them plan for the future, and we help them do that planning.
Oh, that's fantastic. Yeah, I think it's Satara's original question about, are fintech startups well positioned to respond, and will they be agile enough? Like, I think the answer is abundantly clear, but both from what I've seen in our portfolio and what you're telling us now. Andrew, could you tell us a little bit about how you guys responded? I know that you guys had so much stuff in the pipeline right as the pandemic hit, and then had to move really fast to change.
Yeah, so we had two types of responses. One was internal, where we started working from home. Then we started encouraging everyone to learn new skills. So because we started to see that we will need a lot of new types of skills internally, because we were not planning on hiring. It was better that we conserve the resources that we had. So it was more of everyone internally just learning new skills for the product roadmap that we had. So that's how we did it internally. Then for our customers, the agents, we had 3 responses. The first one was we started more like a communication campaign just to educate them on how to be safe at the agent location during the COVID-19 period, because most of them still wanted to open their business and make an income. So how to go about social distancing, how to handle cash, how to communicate to customers. So a lot of text messaging, WhatsApp messaging, then some posters that we did and we tried and distribute across the country. So then the second one was we started a hospital cash insurance cover, similar to what Turaco had done. So actually this was from just having conversations with Turaco, since we were both part of the Catalyst Fund. And that was to give agents income safety nets, just in case they were hospitalized because of COVID-19. Then the last bit, which really was also an encouragement to us, was accelerating our product pipeline. So we launched our digital commerce service called Pesakit Address. So we introduced about 11 new partners whom agents could resell their products. And so far we've seen about 4,700 orders being processed by agents since we launched the new service in July. And this is a new service that's giving them extra income beyond what we used to offer as Pesakit. And what that has enabled us to do is, when we are now rethinking about our projections, is I think digital commerce will be 60% of the income that we generate as a business, and also for our agents, then 40% will be the traditional services that we used to. So that has given us some sort of 50-50 pivot of the business as we now look forward to the next few years.
It's really interesting to hear. I think we started out talking about users and the communities and what's happening with them. And I think, Andrew, you started to talk about what you guys had to do internally in terms of conserving runway. We're hearing that from a lot of startups, upskilling while you're at home. Anything else you can tell us about, how you manage as a team and as a startup? How Maha mentioned, for example, thinking about new forms or alternative forms, be it debt or grants, instead of trying to raise equity. Maybe give us a little insight to being a CEO in these times.
So it's so for us, for fundraising, it's been when it was very exciting for us when I look back, let's say into February, when we were just we were still accelerating the business. We thought it was a good time to really go out and fundraise. Then the pandemic happened. Then a lot of other things started to change with investor preferences. So what we did was we decided to try and utilize the resources and increase the runway that we had. And so we paused on the investment strategy until last month. And so last month, what we're starting to see is we're starting to see investors who are more keen on our business model, investors who want to do tech due diligence, investors who want to understand if really you're at product market fit or what resources do you need to get there. So, and that's what I'm starting to like when I'm having these conversations with investors. So I think we'll be quite successful with our equity raise that we are doing now, because the questions are more relevant and they're questions we can answer very well because of the amount of work we put in during the time that we decided to pause and just focus on the business. So in terms of debt raise, I think we've also seen investors coming to us with that kind of offer where it becomes like a mixed instrument where it's equity and it's also debt. But my alignment is still towards equity, but we'll just see in the next few months how that pans out. Yeah, cool.
Megan, can I turn the same question to you about sort of operations and raising? I know you've had a slightly different experience.
Yeah, so I mean, very similar with operations. We told everyone, take your technology and get ready to work from home. Luckily, our company already had a culture of remote work because we're split across Ghana and Nigeria. And in Nigeria, we don't have an office. Everyone already works from home. We had some additional complications in that I did not yet have my residency permit for Ghana. So I started working from home in the US at my parents' house, which also allowed me to cut my salary to preserve runway since I was back at home with mom and dad. But yeah, we definitely, the first thing we did was conserve runway. So there were people we were planning on hiring. We held off on hiring. Like one of my last meetings in Ghana was a getting to know you lunch with someone we were about to hire. And then we stopped spending on marketing and relied only on organic growth for the whole period. And I really do think that was the right approach, because how Oze becomes sticky with our customers is that it becomes a habit for them. And during these times when there is so much uncertainty, we knew that people were going to have trouble forming habits. There's also so much cognitive load with the new habits we already needed around hand washing and mask wearing that we didn't want to spend to acquire customers. So we thought we had a lower chance of retaining. I think that, I mean, that led to complications with fundraising, and that you see, you know, big growth. We were growing 66% per month on average before the pandemic hit. And then we flattened out completely during the pandemic. Luckily, we're a bit of we're a B to small business, but we also have some B to large business and organizational aspects, and those we're able to continue, especially those customers are used to working remotely, and that actually came through and being a really important part of the story for us that allowed us to raise a seed round, which should be closing imminently. And I'm going back to Ghana on Sunday, so everything comes.
Oh. Yeah. I'm sure your parents are going to miss you, but I can imagine you're eager to get back. We're of course, as always happens, running quickly out of time, and I know there's a few questions from the audience, so I'm going to turn it to Maha so she can share those questions with you guys.
Great, thanks, Malika, Megan, and Andrew. This was really fascinating, and I have so many questions that I will ask you guys later. And in fact, Megan, you were actually answering a question that someone asked about customer acquisition and whether, you know, this pandemic has, and I think it was, yeah, whether this pandemic has impacted customer acquisition, which you've just answered for us. And Andrew, I'm just wondering, you know, with mobile money agents as well, was that something that, you know, you put on hold, or were you looking at customer acquisition in this difficult time? And if so, what would be the strategies?
Yeah, so we decided to take on a digital first kind of model to acquire customers. So we started doing a lot of social media activities on Facebook and Instagram because we knew there are agents who use social media, of course. So we could reach them and we could tweak some of the activities we were doing to be very targeted to small business owners who are also mobile money agents. And then the other thing we changed was the digital onboarding. So we allowed agents to self-register themselves onto the platform and do the entire KYC process by themselves. Then at the end of it all, probably receive text messages from us or calls if we could see their profile wasn't complete. And then the last thing we did was to gamify the entire user profile completeness process. So because we acquire you digitally and we can't see you, so we're just giving you different nudges to help you continue with the onboarding process until you become an active customer.
Oh, that's really interesting. So meeting them halfway as well and understanding, their own strategies. Super interesting. We have a question actually from Herman at the Cambridge Center for Alternative Finance. Sorry to call you out like that, Herman, but I think it's they've been conducting a survey at the global level on fintechs and their response in COVID, and we look forward to the findings. And so he asked if you can, the fintechs can actually give insights on your engagements with regulators during COVID-19, and if so, was how constructive the engagement was, and what else you think regulators could have done to support your response to COVID-19.
Okay, so I'll go first. So in November 2019, we had participated in a hackathon that was organized by the Central Bank of Kenya. And so I was quite surprised during the pandemic when at the height of the challenges we were facing here in Kenya, they used to call us just to follow up on the last on us because we were finalists in the hackathon that they had organized. So they were calling about 15 fintechs in Kenya just to try and understand what were we doing, how are we responding, how could they help us. And they used to do every other 2 weeks. We could have calls. They were thinking of having a fund that could support small businesses or having a fund that could support fintechs. That never came to fruition, but I really liked that they were actually thinking about it. They were thinking of how they could support employees who are working for small businesses. So the other company that possibly got those calls is Quora, because we were finalists together in that hackathon. So that was very good from the Central Bank of Kenya. And now when we're trying to, let's say, approach them for advice on which kind of licenses would require in the future, they're very open because we already have a relationship going because of that time. So it's so easy for us now to get guidance and get some of those doors open.
Yeah, I think we have less direct relationships with regulators because we're an integrator. So we help banks lend to small businesses, but we don't do lending ourselves. And we will shortly be helping PSPs provide payment services to small businesses, but it's not something that we do ourselves. But Ghana's regulatory landscape is changing in 2021, and there are some things that we had to do to get prepared for that. And I was very happy with the Bank of Ghana and the way they were able to go from really needing to show up and have face-to-face meetings to being open to just hopping on a Zoom call and working with you. So it's we've only really worked with the regulators during COVID, but I've been happily surprised.
Well, it's great to hear that both of you are talking about support that you're getting from the regulators. One question that I have, that we have actually, is that our survey that we conducted that has demonstrated these creative measures that fintechs seem to be employing, and you have just given us some really great stories of how you guys are being really agile and responding quite quickly. So I would love to hear in the next couple of minutes any advice you both may have for fintechs in your position responding to the pandemic and customer needs. You have top 2, 3 advice for them. That would be really great.
Yes, so for me, the big advice I would give fintechs is to do proper talent planning from now moving on, because I think the business landscape will change. The different needs that our customers will need from us, and we need talent internally just to be able to serve them well. So one thing that was a big takeaway for me was how better to do talent planning. The other one is just to think about, just to think about your customers, and if you have providers, is some of the biggest assets you have for your business. Because like for us, what kept us going, like what kept me motivated was just seeing customers downloading the app and new customers joining. Maybe every 30 minutes we could see about 11 people have started using the platform. So I think those were my biggest champions at that time. Like those were my biggest motivators. And I think moving on, we now need to just put the sole focus on our customers, and if it's a B2B model, the providers, because also what I've realized is the providers can also be some of your biggest investors. If let's say they're providing debt on your platform, that's something you could consider as investment. Or if it's an e-commerce platform where you have, let's say, stock that you need to resell, that's already in some way capital in your business that will generate income for you. So just those relationships and talent planning are my biggest takeaways from the last few months.
Yeah, I would echo all of that and say just continue to be a trusted advisor for your customers. We built Oze on a foundation of human-centered design, so our customers have always been, especially the early adopters, have always been equal part customers and colleagues. And we have, through WhatsApp groups, the ability to talk to our different groups of our customers to really understand how the app is working for them and how the app is not working for them, and what are the challenges in their business, and what role do they think we can play in helping them overcome those challenges. And it's hard to tell, what changes in operations are going to have to persist in the medium term, long term, short term. And so I think continuing to build kind of the muscles internally to listen and iterate quickly will allow you to continue to succeed no matter what happens with the pandemic and the global economy.
Thank you, guys. We're going to end on time. So I just wanted to close by saying thank you to both of you so much. I know CEO time is so precious, so we really appreciate it. And to all of the attendees, to please go to the Axion website and to the Catalyst Fund website at BFI Global to sign up for our newsletters and check out the blogs that have more details about the surveys that we conducted. And to look out for, I would encourage you to look out for just the plethora of data. That's, I think, a really positive side of what the pandemic has created, just the need for more data and the number of institutions that are rising to that challenge. I just saw some really interesting data, for example, from 60 decibels. And I know FAI is presenting, I think later today, similarly, some really interesting insights. So again, thank you for all your time, and please be in touch.